to the Veterinary Financial Podcast, where we discuss financial freedom and professional success. I'm Meredith Jones, a veterinarian and financial planner for vets.
And I'm David Aizuss. I'm also a financial planner for vets. Not a vet myself. You don't want to ask me about your cases, but I sure like helping you guys with your finances.
So today we are going to talk about some real-world mistakes that we've seen our veterinarian clients making with Roth IRAs. I want to preface this by saying that there's no real expectation that you should know anything about Roth IRAs, right? Because we didn't learn about that in vet school. So we just wanted to talk about some common errors that we're seeing working with vets as financial planners. And if you've made one of these common mistakes, it's okay because you're not alone. And if you've asked one of the common questions that we're going to talk about, that's great. People who ask questions can avoid making these mistakes. That's the goal here. David, to start with, could you just define for our listeners just what a Roth IRA is before we get to mistake number one?
Of course, because it's a term that's thrown out a lot, and I really think most people actually don't actually know what it is. So a Roth IRA is a type of account. It's not an investment. It is just an account, just like your bank account is an account. It has certain tax advantages. And what I mean by that is, well, if you go invest in a not retirement account, let's say you buy a stock for $100 and then it goes up to $150 and you did that in a not retirement account, a not Roth IRA. When you sell and you make a profit on your investment, you're going to have to pay taxes on that in some way. Short term, long term, we get really complicated defining all the different ways you can get taxed, right? Between capital gains, dividend income, whatever. That's not the point of this. The point is that if you invest in a not retirement account, you're going to be taxed in some way. So you don't get to keep all the profit. Now, if you invest in a Roth IRA, that type of account, the tax advantage is, if I go buy an investment, whether it's a stock, an index fund, an ETF, whatever, if you buy that investment for, let's say, $100, you hold it for 30 years, it turns into $175, $200, whatever, by the time you retire, and then you want to sell and take that profit, tax-free growth. So whatever you invest in the Roth IRA, when you go take it out in retirement, tax-free. So that's why everybody loves it. And it is a great type of account. So tax-free growth, that's the point of the Roth IRA. The two catches are, one, because it's a retirement account. Well, there's a few catches. Since it's a retirement account, you can't withdraw the money unless you want to pay penalties and taxes on it before the age of 59 and a half. So for the purpose of this discussion, there are times you could break the glass, but for now it's, we're going to assume this is long-term money. We're not trying to take penalties on it. We want it to grow even if there was no penalty. And that's how you get the tax-free growth.
All right, awesome. And so, David, what's our first mistake that we often see with our clients?
One of the main mistakes we see a lot with our clients, again, veterinarians specifically, is not understanding how the earning limits work. Particularly, one of the catches of, can you do this or not? Because that tax-free growth is so beneficial to so many people. The government puts some handcuffs on who can access this type of account in the first place, who is eligible to contribute to one. And one of that is how much money you make. I'll try to keep this as entertaining as possible because I can already hear and see you guys glazing over. I don't even know if that makes a sound or not. But again, at the end of the day, we're trying to make it so that you can make and save the most money possible. And that is at least fun to me to talk about. So if you're still with me, the big catch is, once you start making over about $140,000, you start not being able to contribute the max. The max right now is $7,000 per year per individual. And once you get over that income limit of about $140,000, that max goes down. But after a certain limit, around $160,000, you cannot contribute at all to a Roth IRA unless you do a backdoor Roth. Maybe we'll save that for another episode or talk about it later. There is a way around it. But if your income is over a certain limit, you cannot contribute. But the big mistake isn't not knowing that there's some income limit, because a lot of people do realize that. The big mistake is not understanding, what do they use for your income? A lot of people think it's their salary. Mm-hmm. It's not. It's based off of your tax return. Technically, it's based off of something called your modified AGI. Not to get too into the weeds, the point is, well, what if you started making $100,000 a year pay rate, and then halfway through the year, and maybe you were a new associate out of vet school, but then all of a sudden, 6 months out of graduating, you decided to become an ER relief vet full time. And now you're making over $200,000. Depending on what it showed on your tax return, depending on how much you actually made in that calendar year, that's what determines whether you are eligible to contribute for that year, not your pay rate. It's how much you actually got paid throughout the year. Does that make sense?
Yeah, that makes sense. I'll also offer an aside that maybe 6 months might be too early to be a emergency relief
Yeah, that's
vet.
for the really crazy people. I've seen people do that. I don't necessarily recommend it, but that's just, and maybe you're not a new grad. Maybe you're 3 years out and you have some sort of career change, whether it's you're switching practices, whether it's you got a raise, whatever. Whatever it is, your pay changes. Just know it's not based off of the new pay rate. It's based off of how much you actually earned throughout that year. So people sometimes rule themselves out of contributing when they actually could because they think they made too much, when it turns out, oh, they got that pay bump near the end of the year and it kicked their total pay that they made throughout the year from 120 to 130. You could still do it, but they thought that they couldn't. And then the opposite, some people don't understand how their pay actually works or is calculated into this, and they contribute when they shouldn't have. And that's really annoying. And then you got to recategorize it and do a bunch of stuff that you as a vet probably just don't want to worry about. And just to keep other things in mind, it is total pay that you made throughout the year. So again, it's not just your base. And a lot of you associates out there might be on ProSal. You get a base plus production. So it's on everything, including that production. And hey, what if you did a couple relief shifts here and there? Count that too. So it's your entire income throughout the year, not counting those bonuses, not counting production, not counting relief shifts. That's a huge pitfall that we see a lot of vets not account for. Meredith, do you have any horror stories to share of your clients? Because I could think of a couple.
I mean, I guess a horror story would be if somebody didn't realize that they were over the income limits and they've been doing this for the past 3 years, and then they've got to go back and recategorize and do a bunch of extra paperwork and having to worry about moving money around. And so things that you don't want to do that just complicate things. And then the other thing that I've seen is, so let's say you were contributing to a Roth IRA directly early in your career, and then you get to the point where you're making over the income limits to contribute directly to a Roth IRA. A lot of folks will ask me, okay, well, if I'm doing at that point, and we'll talk about a backdoor Roth IRA and what that means, but if they get to the point where, okay, they're over the earnings limits and now they need to do a backdoor Roth IRA instead, they'll say, well, what do I do with the Roth IRA that I already have? The answer is nothing. So if you were under the income limits and you contributed directly to a Roth IRA, in the future when you make more money and you can't contribute directly, there's nothing that you really need to actually do with the money that you previously contributed. It's on a per year basis. So if you're above the earnings limits 1 year, and you're doing a backdoor Roth IRA, that's fine. It doesn't matter if in a previous year you were under the earnings limits and you were able to contribute directly. That's totally fine. Okay, so I already said backdoor Roth, right? So
yeah, so we should probably define that too for those people, right? So because you hear that term thrown around a lot too, and I don't think a lot of people really understand what that is. So what that is, whenever you hear backdoor Roth, and if your eyes are still glazed over, that might be a reason to hire a financial advisor or planner to help you guide for your specific scenario. Just saying, because as you can see, it can quickly kind of get complicated, even though we're just talking a plain old Roth IRA. But anyway, backdoor Roth. What it is, whenever you hear that, is what if you are not eligible to do direct Roth IRA contributions, but you really want to because you want to get that tax-free growth. Okay, if let's say maybe you make too much. Maybe you're single and you make $200,000. Great, you can't do it. Good problem to have. There's a way around it. The process itself is pretty darn simple. There's just some things to look out for before you try to do it. The process is, and what a backdoor Roth is, you open up a what's called traditional IRA. So not a Roth IRA, but another type of IRA. And you contribute to it. You got to make sure, let's say there's nothing in it. Okay. So let's say you contribute $7,000 directly to that traditional IRA. Then you're going to transfer from that traditional IRA. So you're not going to invest in it, just cash in that account. Then you're going to transfer that money that was in the traditional IRA to the Roth IRA. So it's just adding one extra step. Instead of going from money in your pocket to the Roth IRA, it's money in your pocket to the traditional, and then from the traditional to the Roth IRA. That's it. So maybe it takes an extra day and a little bit of paperwork. So it's no big deal. But Meredith, this is, again, common pitfall number 2 that we see all the time with vets, other people too, but I do see a lot with our vet clients is, what's this pro rata rule? Like, what's wrong? What do people get wrong with the backdoor Roth? And what do you got to look out for?
Yeah. One of the biggest things that I see that's a mistake with backdoor Roth, or just something that people don't know about, is that if you are at a point where you want to do a backdoor Roth IRA because of the earnings limits or because you're married and filing your taxes separately for student loan purposes, if you're using a backdoor Roth IRA, it's not a good idea to have a backdoor Roth if you have a balance in any other type of IRA other than a Roth IRA. So if you have a rollover IRA where you took your 401k from your previous employer and you rolled it into an IRA, or if you have a simple IRA. So some vets, especially at independent practices, or if they used to work at an independent practice, a lot of our vet clients will have a simple IRA from a previous employer, for example. So if you have a rollover IRA, a traditional IRA that has a balance, or a simple IRA, or a SEP IRA. So I'll throw that one in for some of our self-employed folks. If you have any of those types of IRAs, then you run into the pro rata rule. So the short version of that, and I'll explain it in more detail, but the short version and the reason that you don't want to do it is because if you do a backdoor Roth and you have a balance in one of these other IRAs, it's going to cost you extra money in taxes. So that's the reason you don't want to do it. We want you to save money in taxes. We don't want you to have extra money that you're having to spend in taxes. Okay, so let's explain the pro rata rule. Okay, so typically when you do a backdoor Roth contribution, it's a tax-free conversion. Like David explained earlier, it's a tax-free conversion from the traditional IRA to the Roth IRA, and you've already paid taxes on the money up front, and you're not going to pay taxes on it again, even when you take it out in retirement. But the catch with that is if you have any funds in a pre-tax IRA, so that's like the simple IRA, SEP IRA, traditional IRA, rollover IRA, then the backdoor Roth contribution is no longer tax-free. So the IRS is going to treat all of your IRAs as if they were one big account, including that Roth IRA, and then they're going to require you to pay a proportional percentage in tax on the conversions. It gets more complicated from there, but basically you don't want to have any other type of IRA that's not a Roth IRA if you want to do a backdoor Roth IRA for that reason, because you don't want to pay extra taxes.
That was complicated. So I guess long story short, just be careful. The backdoor Roth process can be easy, but it also can be difficult depending on what type of accounts you already have, really, and what's in those accounts. And this will bring me to the next point of number 3, some big mistakes with Roth IRAs and IRAs in general, but those traditional IRAs can make things a little bit more complicated.
Yeah, and let's talk about too, just like, okay, well, if you have a simple IRA or you have a rollover IRA, what can you do with it so that you can do a backdoor Roth moving forward? And so what we're often talking with clients about is, okay, if they've got, for example, like a rollover IRA, if they have a 401k with their current employer, or for folks out there who might be working for academia or nonprofits, if you have a 403b account instead, what you can do is you can take your rollover IRA IRA, and you can do what they call a reverse rollover, and you can combine it with your 401k. That's a way of, quote, getting rid of your rollover IRA so that you can then do backdoor Roth IRAs moving forward. Same thing with a simple IRA. So a lot of folks will have, maybe they worked for an independent practice that got sold to corporate, and they have a simple IRA from before they worked for the corporate practice. Well, they can take that simple IRA, roll it into their current 401k, and now you don't have that simple IRA anymore to complicate things.
Nice. So the way to get around it is really figure out where can you move your IRA assets to where to make it so that you don't have to worry about this crazy pro rata rule.
Yes, exactly.
Again, gets complicated real fast, or it doesn't. You just need to know what you're doing and be safe out there, guys. Number 3, a huge mistake that we see regarding Roth IRAs in general really is contributing post-tax money to a traditional IRA instead of using a backdoor Roth in the first place. It's doing the thing that can make doing a backdoor Roth really difficult instead of just not doing it at all. This is actually really applicable to vets. So let me back up. Traditional IRA. What's the tax advantage of that? Because we've only talked about the tax advantage of Roth. Well, traditional IRA works supposed to like your traditional 401k with your employer. The tax benefit when you get it, and most of you listening are probably not eligible for this benefit in the first place, which is why this is very vet specific. The tax benefit of the traditional IRA, the main one, is, well, when you make the contribution, it lowers your taxable income on paper. So if you made $150,000 that year, but you had contributed $7,000 towards a traditional IRA, one of the benefits is, it should have brought it down to $143,000. And therefore, you just hid $7,000 away from the government legally that you don't have to pay taxes on. Otherwise, you'd pay taxes on that $7,000, and depending on what state you're in income taxes, right, you might be paying 25-30% total taxes straight to the government. Plus, it impacts your student loans. Again, anything you contribute to the traditional side, whether it's a 401k or Roth IRA, lowers your taxable income. It lowers that AGI. The problem is, in the example I just gave, you made $150,000 that year and you contributed $7,000. It's actually not going to lower your taxable income on paper anyway. You don't get the tax deduction because there is a really strict income limit that's way lower than the Roth IRA limit. So you can still contribute, but you're not going to get that big tax deduction. It's the same thing as really if you just contributed to your brokerage account, your not retirement account. You're not lowering your taxable income. You're not getting that instant tax savings. Still goes tax deferred, but again, that $2,000, $3,000, $4,000 that you could possibly, depending on what state you're in, save on taxes up front by doing it, you're not going to get if you're making vet income, period, end of story. I think the limit's around $80,000. So that's one huge mistake, is thinking that you're getting this huge tax benefit of the traditional IRA, but you're not, because you actually make too much, but you're still allowed to fund the account. So it's kind of weird. But then because you thought you were getting this big benefit, and then you want to go do a backdoor Roth, well, now you have post-tax money. You paid the taxes on it. You didn't get a tax break for it, sitting in that traditional IRA. And now we circle back to the pro rata rule. Ooh, you've got a bunch of post-tax money sitting in a traditional IRA, which didn't give you the real benefit in the first place. And now it's going to cause a huge issue, potentially, when you want to do a backdoor Roth. Back to issue number 2. Meredith, any thoughts on all that? Did I miss anything?
Yeah, I mean, whether it's a huge issue or a small issue depends on how much you've got in that account. If you've only done that for a couple of years, not really a big deal, because you've got a small balance in that account. You can still get that post-tax traditional IRA. You can still get it converted over to a Roth IRA, so you can do a Roth conversion. You'll have to pay a little bit of taxes. It won't be on the whole account, but it'll be on the growth in that account that you'll have to pay some taxes on when you do that conversion. But that is a way of getting rid of that account if you do want to do those backdoor Roth contributions moving forward.
Actually, quick story of how it can be a big deal as far as time invested goes is I had a client who very recently, a veterinarian, who wanted to do a backdoor Roth. it wasn't a rollover from a previous employer where, to Meredith's point, you might be able to just move that into, do a reverse rollover into your new 401k. Easy. But they had a traditional IRA that was zero, that was from no previous employers or whatever. They've been contributing to it for like 7+ years, something like that. And so they had, including the growth, over 50 grand in it. It might have been over 60 grand. And so we had to go back and figure out and pull tax returns from like the last 6 years, which can be a pain sometimes. And we had to figure out, because there's a certain part on each year's tax reform that can tell you whether they were eligible for that deduction, because we knew they were over the income limit today and last year to not possibly get that deduction of the traditional IRA. But what about 5 years ago? Depending on when they graduated vet school, there were a few years out there where the client had no clue whether they took the deduction or not, and had no clue whether they were above the limit or not. It's just a ton of extra work, because maybe it's a small tax consequence to convert everything to Roth. Maybe it's not. You want to do your due diligence, and maybe 5 extra hours of work to figure out that it was a no big deal or it was a big deal could have been avoided if you just didn't do the traditional at all in the first place, maxed out employer 401k along the way if you want that tax benefit, and then it was a non-issue, right? So it could save you a lot of time. I guess you could say for a lot of vets, again, consult your own financial advisor about this. It's kind of rare that I recommend someone just straight up do a traditional IRA, especially for a veterinarian, because we already know you're probably going to be, if not already, over the income limit to get the benefit out of it, and it's just going to cause issues for the backdoor Roth that we'll probably want to do eventually. Meredith, thoughts on that? What do you think?
Yeah, well, the other thing I'll say along with that is that vet incomes, of course, they have increased significantly since COVID. A lot of these problems that we're talking about right now, 10 years ago, it wasn't a problem because vet incomes were lower, right? And so it was more of getting to the point where you could max out your 401k. That was more of the goal versus being able to, and we'll in the future, talk more about the 3-bucket strategy, but 3-bucket strategy is where you've got different retirement buckets, right? So you could fill up the first one as the 401k, second one as the Roth IRA or backdoor Roth IRA. And then if you want to save even more for retirement or do even more investing, then you've got a brokerage account. So if we turn the clock back 10 years ago, a lot of veterinarians with where their income was, bucket 1 was the bucket that they were focused on, versus now we have larger incomes to work with, which is a great thing, but it does get more complicated.
Good problem to have for all those vets out there. But yeah, with success, with rising incomes does come, as you can see, more complexity. Meredith, what's number 4? What other mistake do you very commonly see happen with these Roth IRA stuff?
Number 4 is not knowing that you can't file your taxes married filing separately and contribute directly to a Roth IRA. So we talked about the income limits just in general for, and they're different for singles and versus married filing jointly. But what we haven't talked about yet is that if you make more than $10,000 and you are filing your taxes married filing separately so that you can save money on your student loan payments. So a lot of people are filing their taxes married filing separately so that instead of their student loan payments on income-driven repayment being based on their income plus their spouse's income, they want it to be just based on their income. So they file their taxes married filing separately. So if you do that, then realistically, because probably every vet listening to this makes more than $10,000 a year, especially when we're taking into account the whole household, right? If you file your taxes married filing separately, then you can't contribute directly to an IRA, even if you are below the income limits. Meaning, even if you are below the typical income limits, like that 161K that David was just talking about earlier. So you have to use the backdoor Roth IRA if you are filing your taxes married filing separately.
I wonder who made that rule of like, you know what? Anybody who wants to do married filing separate, let's reduce the income limit to $10,000. I don't know who. I'm not an accountant. It just fascinates me how it's like they're throwing darts at random rules, and that's how they made it. I don't know. But I actually got lucky. Before my wife and I got married, we were doing direct Roth contributions, and then incomes changed, and then after we got married, did married filing separately for the first time for student loan purposes. Didn't know about that, but we had happened to have paused our Roth IRA contributions so that we can save up more cash for future home purchase. And it just, the calendar year made it work where, oh, we got it right accidentally by like a month, but that was lucky. So a lot of people getting married out there who are privy to the student loan strategies of doing married filing separate, just be careful. You might have, depending on the timing, you might have contributed to your Roth before you got married, and then you got married, and getting married it's always by the end of the calendar year. Retroactively, you should have known not to contribute directly to your Roth, and you might have to do a recategorization. I got lucky. Meredith, are we ready to move on to number 5? Anything else we need to say about married filing separately?
Oh, yeah. Just a little bit about what you were just talking about, just planning ahead. So let's say you set a wedding date and you're getting married next year in June. So if you're getting married next year in June, but you've got student loans and your fiance doesn't have student loans, and you're probably going to end up filing your taxes married filing separately, that would actually be a time where you would say, okay, future spouse, starting in January, you're not going to be ideally contributing directly to a Roth IRA anymore because we're going to have to do a backdoor Roth IRA in the future. So just a little spark to just think about future planning.
And those listening to this are probably the ones, I call you guys like financial mutants. You're probably extra interested in this subject more than the average vet. But a question that just comes to mind for me is, well, how are you supposed to plan for something that you don't know that you don't know? How is a vet supposed to know that, well, one, to consider married filing separate in the first place for student loans, because that's kind of a niche thing to know about, right? But even if they do know that, how are they supposed to know if nobody's told them that if you do married filing separate and they're not even married yet, now all of a sudden they shouldn't have done direct Roth contributions throughout that entire year, even previous to when they were married? That's like, you either need to know the future or like be psychic to know what you don't know, or super knowledgeable in this, in which case, if you're a vet, you're probably spending most of your time being like a doctor. Option 3 is you probably just want a good professional in your corner, to teach you these things so that you can look out for it. Because I feel like there's so many landmines and pitfalls with these kind of things of like, turn here, oops, shouldn't have done that. How are you supposed to know? Well, you either learn by somebody telling you or by making the mistake, and that's not fun. Number 5, thinking Roth is the best option always. This is I think my favorite one, because a lot of content in the financial planning space, not even just content online, but like a lot of people always think a Roth IRA is always the best thing that you should do with your next dollar that you can save and invest. And that's just not true. Some people absolutely should prioritize it. Some people shouldn't. It just depends. And that's the thing with anything finance related. The answer of what you should do is it always depends. And I'll give you an example and a huge mistake with the Roth IRA and thinking you should always do it. Let's think about it. Here's when it's maybe a no-brainer. It does always depend, but the no-brainer of like you should do it is, what if you're in like a no income tax state, like Texas, like Washington? You're not paying state income taxes, so you're in a lower tax bracket than everybody else who's making the same amount of money that you are, who lives in California like I do. Probably just don't move to California is what you should do with that info, but I'm just kidding. So let's say you don't live in an income tax state. Maybe you're not a vet, and what if you as a household make 50 grand combined? Especially if you're in a no income tax state, you're not paying a ton of taxes. The way you do the standard, even if you just take the standard deduction, you're not itemizing, you might only have about 20-ish K of income that they're only going to tax. And you can go look up what the federal rate is, your federal tax rates are on the first 20K of income. Total, you might only be paying 0 to 10% in taxes. In which case, and maybe you don't have any student loans either. Maybe you're lucky and you don't have any student loans. Good for you. So, okay, you're not paying much in taxes right now. You don't have any student loans. You might as well do Roth over like trying to maximize your traditional 401k first or the traditional IRA, because take the tax hit now and then take those dollars, invest it, let it grow tax free. You weren't going to get this big tax deduction anyway from trying to do traditional IRA or traditional 401k. Flip that. What if you're a vet and you're making 150, 180, 200,000? What if you're making 300,000? Maybe you run an at-home euthanasia clinic and you're doing great. Again, post-COVID, as Meredith said, vets make a lot. And so the more you make, the higher marginal tax bracket you're in, the more you're going to save by putting those dollars in like your traditional 401k, not prioritizing the Roth first. It'll also lower your AGI and lower your future student loan payment. You might be technically in like a 40% marginal tax bracket. Maybe not doing Roth first, prioritizing traditional makes more sense in that case. It just depends. But I don't want to take up too much of your guys' time with that. The answer is, again, the mistake is don't always think Roth is always best. Sometimes it's not. Meredith, what else do we got? Are we boring people to death? Do we think we just made people rich? How should we wrap this up?
I'll throw in a bonus one. So the other thing that I see sometimes clients will move over, maybe from another financial advisor they've worked with previously who had the conversation with them like, hey, you're above the earnings limits, and so you can't do a Roth. And just didn't even bother with, whether it was they didn't want to bother educating them about the backdoor Roth, or whether they didn't want to deal with, extra paperwork or whatever it was, just it being something that they didn't know about. Maybe they were working with someone who just didn't realize the value of backdoor Roth IRA. So that's just another thing to keep in mind. It's something else that I've seen out there.
Yeah, definitely. If it makes sense to do a backdoor Roth, you want someone to help you do it, not just not do it because it takes a few extra steps of work, right? Do what makes sense. Well, I think that's a good place to end it. So I'll wrap this up with saying, hey, if you liked what you heard, but it got overwhelming, it got too into the weeds, you're not sure what you should do with this information, or you want to learn more, or again, you want personalized financial advice, go ahead and go to slpwealth.com/pod. Again, that's slpwealth.com/pod. We would love to work with you. If you want a free intro call to even see if it makes sense to have a financial advisor, or see if you'd be a good fit, or just ask any questions you want, go to that link. Again, we do this podcast because we want to help as many vets as possible. And I mean that. That's why we specialize in working with you guys.
Thanks, David. Until next time, take care and continue your path to financial success.
This podcast is for informational and educational purposes only and should not be considered individualized financial advice.
If a specific investment is mentioned, it should not be considered a recommendation or endorsement to buy or sell the investment.
All investments involve risk.
Past performance does not guarantee future results.
You are encouraged to seek the advice of a financial professional before implementing any investment strategies discussed.
Yay, compliance.